There are two sides, or what we call legs, on an interest rate swap. Typically, one side would be floating rate and the other on a fixed rate basis, though they could technically be both on a floating rate basis. This is what we call a basis swap. For example, you might be paying 3-month dollar Libor on one side and an interest rate linked to the treasury bill rate or a prime rate or a commercial paper rate on the other side. Now, the frequency of the legs can be different. So the floating leg might be paid on a quarterly basis, with the interest rate being set every 3 months, while the fixed leg could be paid annually or reset once a year. It doesn't matter. Also, the two interest amounts might be calculated using different day counts. For example, you might calculate the floating interest rate on an actual 360-day basis, and this is what we see in some markets like US dollar Libor, Euribor, Yen Libor, Shibor in Shanghai, and so on. On the fixed leg, you might want to pay it on a bond basis. Now, this means actual 365, in this instance 3360 or actual. Nominally different day counts, but mathematically they come out to pretty much the same thing. There might be a slight variation between one or the other, but on the whole they're the same. Now, does it matter to the value of a swap that the day counts are different and the frequencies are different when we price it up? Not really, as long as the present value of the two cash flow streams is the same. So if you want to change the fixed rate basis from semi-annual to annual, not a problem. I'll just change the fixed rate so that the present values are similar. Now let's take the example of the swap shown here, and what I've done is I've drawn it out with boxes and arrows, and you can see here that both legs are paid semi-annually. Now it is just the interest payments being exchanged. It's not a cross-currency swap. There are no exchanges of principal, which wouldn't really make sense. Now, when we look at the Libor setting, here's the page that would be used for the Libor. It used to be run by the British Bankers Association. Now it's the Intercontinental Exchange. And we can see that 6-month Libor for the first setting sets at just over 1.45%. Now, if I compare that to the fixed rate, which will not change during the life of the swap, we've got a fixed rate here of 1.83%. Now, what I did is I looked at the actual number of days between the start date and 6 months from then and made sure it was landed on a good business day, in other words, not a weekend for that jurisdiction. And in cash terms, the floating leg is $186,022.72, and the payment on the fixed leg is $230,630.14. Now there's a net difference here of $44,607.42. It doesn't really make sense to have the gross cash flows exchanging hands. So, I give you the full 186,000, you give me back 230. In this case, you owe me a little bit more, since let's just assume you're the fixed rate payer and I'm the floating rate payer. So what it would make more sense to do is for the fixed rate payer just to pay the net difference. Now, what you want to make sure is that you have netting in place, that you agree that you will just pay the net differences every period. Because imagine this scenario that I give you 186,000 that's due from my side, and you say thanks very much. But what if you don't give me your side and default, and you haven't given me your 230,000? So I say, oh, this is great. So suddenly I'm down about $400,000. So this is why you want to get netting in place in your documentation to reduce counterparty risk. Now, do be aware there are some jurisdictions which will not allow netting, but it's a key feature in most documentation, unless, of course, you have central counterparty clearing, which also reduces the counterparty credit risk.